If I had to break down a Treasury company like this from scratch, knowing what I know about the latest balance sheet update, the giant Ethereum stack, the shrinking cash pile, and that massive buyback headline, I would not read this story the way most people are reading it right now. Most people see more coins, more assets, a bigger exchange listing, and a giant repurchase authorization, and they think the conclusion is obvious: bullish. End of story. But that is not what this is anymore. We are looking at one of those setups where the top layer looks clean, the headline looks powerful, and then the deeper you go, the more the strategy starts twisting back on itself. On the surface, this company looks stronger than ever. Under the surface, it looks like management is trying to run 3 different playbooks at the same time. And that, ladies and gentlemen, is where this gets very interesting. It is Tuesday, April 14th in New York, so drop in the comments what day and date you are watching from. And real quick, if you value this kind of content, support the channel by subscribing and commenting John AG Best, so I know you want more of these breakdowns. Now let us start with the part that actually does look good, because it would be silly to pretend otherwise. Based on recently published numbers, the company's crypto, cash, and side holdings now sit at roughly $12 billion altogether, with the Ethereum treasury climbing to just under 5 million coins. That is not a normal corporate treasury. That is not some little speculative side pocket. That is a whale-sized position. More importantly, it now represents a bit over 4% of the entire Ether supply, which means the company is no longer reacting to the market. In some ways, it is becoming part of the market structure itself. That is a very different conversation. And from recent market updates, they have kept up a heavy buying pace for about a month now, which tells me this was not one flashy purchase for the cameras. This looks deliberate. This looks systematic. This looks like management decided they want size, and they want it now. So far, so good. In fact, if the story stopped right there, I think a lot more people would be comfortable with it. Giant Ether treasury, bigger market presence, more relevance, more visibility. The stock also just made the move up to the New York Stock Exchange, and whether people admit it or not, that matters. Bigger stage, different class of attention, different class of investor, different liquidity profile. Management has even highlighted that the shares have become one of the more actively traded names in the country on a recent rolling basis. And that matters because a treasury strategy like this only works smoothly when the market can absorb the story in size. In other words, scale is helping them. Visibility is helping them. The setup is maturing in public. But then the story takes a left turn, because while the coin stack keeps going higher, cash has moved lower. And if that were the only change, I could still defend it. I really could. If management believes Ether has either found a floor or entered a stronger part of its cycle, then rotating out of idle dollars and into a productive digital asset could make sense. Dollars sitting still do nothing. Ether can appreciate, it can be staked, and it can be used as a strategic reserve asset if the broader tokenization story keeps advancing. So lower cash alone is not the issue. The issue is lower cash combined with weaker fundraising and a giant buyback headline arriving at the same time. That is when the math starts looking funny. Because if new money is not coming in as easily as before, every single capital allocation decision gets louder. Every contradiction gets louder. Every promise gets louder. And here is the contradiction in plain English. When a company's stock trades below the value of the assets inside the company, there is a strong argument that buying back the stock may be smarter than buying more of the underlying asset in the open market. That is the simple version. Fewer shares means each remaining share owns more of the treasury. Cleaner, more accretive, potentially more powerful. So if that logic is in play, why keep issuing stock? Why keep diluting? Why keep adding more Ether while the stock itself may already be the cheaper version of that same exposure? That is the part I do not think the average retail holder is wrestling with deeply enough. Because once you see that tension, this stops being a simple accumulation story and starts becoming a capital allocation puzzle. Now, to be fair, a repurchase authorization is not the same thing as immediate repurchases. That is where I want to challenge one popular assumption. A lot of people hear a multi-billion-dollar buyback number and instantly treat it like cash is already loaded into a cannon. That is not how it works. Authorization is permission, optionality, a tool on the wall. It can be a signal to the market that management believes the stock could become too cheap. It can also be a defensive weapon they want available in case sentiment breaks the wrong way. So I do not automatically read the expanded buyback as hypocrisy. It may be management telling you, we want the flexibility to strike if the stock stays discounted long enough. That is a lot more nuanced than the market is giving it credit for. But even after you make that charitable argument, the hard question still remains. If cash is down to a little over $700 million and the authorization is several times larger than that, then where does the firepower come from if management ever wants to lean into the buyback in a serious way? That is the real issue. Not whether the board approved it, not whether the headline sounds impressive, the issue is funding. And when you ask that question, there are only a few realistic paths. 1, raise more money, which becomes awkward if the stock remains below the value of the assets. 2, wait for the stock or the asset to move so the balance sheet improves. Or 3, sell some of the crypto reserve to fund the repurchase. That is where the conversation becomes very tricky because the company has not been acting like it wants to reduce crypto exposure. It has been acting like it wants more of it. And that brings us to the staking piece, which is easy to overlook, but very important. According to the latest publicly available filings, more than 3.25 million Ether is already staked. And at current scale, the annualized staking revenue run rate is a bit above $200 million. With management saying the figure could move into the low 300s when the full system is operating at greater scale. That matters because it changes the economic personality of the Treasury. This is not just a pile of coins hoping for a higher chart. It is also a yield-generating machine. And once an asset starts paying you like that, selling it becomes a much harder decision, especially if management sincerely believes Ether is benefiting from two separate tailwinds at the same time: Wall Street pushing more real-world assets and financial activity onto blockchains, and agentic artificial intelligence systems needing open, neutral networks to settle, verify, and coordinate activity. You do not have to agree with every ounce of that thesis to understand why management might not want to part with the asset easily. Now here is the subtle thing that could explain more than people realize. Not all of the Ether is staked. A meaningful portion remains liquid. That matters, because a liquid reserve gives management room to maneuver. They can keep most of the Treasury working for yield, while preserving a chunk that could be sold later if they need to fund repurchases, acquisitions, or some other balance sheet move. So maybe the strategy is not contradictory as much as staged. Maybe management is saying we want maximum exposure if the market keeps lifting, but we also want a liquid sleeve available in case the stock discount becomes too attractive to ignore. If that is what is happening, then the strategy is still complicated, but it is not irrational. It is basically a dual-track setup. Keep the core Treasury compounding. Keep some dry powder in reserve. Leave every major door open. That does not mean I think the market should blindly trust it, though. Bigger is not always better. A giant Treasury can look genius in an uptrend and fragile in a drawdown. That is the skeptical side of the story. If Ether stalls, if funding remains weak, if the stock discount refuses to close, then what looks today like optionality can start tomorrow to look like drift. And once investors begin to suspect that management is trying to solve too many problems at once, the discount can widen, not tighten. So I do think there is a very real risk here that people are falling in love with the size of the Treasury while giving too little attention to the structure wrapped around it. Now let us widen the frame, because the backdrop matters here. In the United States, the policy tone around digital assets has clearly shifted. Treasury Secretary Scott Bessent has publicly pushed Congress to advance a federal framework for digital assets, arguing that unclear rules have driven development and investment overseas, and that the United States needs a clearer structure if it wants that activity anchored at home. That does not magically remove regulatory risk, but it absolutely changes the temperature around the sector. And when a company is built around a giant crypto treasury, changes in policy temperature matter more than people think. At the same time, one of the biggest brokerage brands in America now says its direct crypto offering is coming soon, with early access updates already live for clients who want to buy and sell Bitcoin and Ether through a dedicated crypto account. That is not some niche crypto-native app talking to a tiny crowd. That is mainstream distribution. That is convenience. And convenience changes behavior. A huge number of investors do not buy an asset while it sits 3 steps outside their normal investing world. Put it on the same shelf as the rest of the portfolio, and suddenly adoption gets easier. That is a very big deal for market depth over time. And outside the United States, the tone has shifted too. Japan's cabinet just approved changes that would move crypto assets deeper into the financial instruments framework, a step that points toward tighter rules but also greater legitimacy. Again, that does not mean straight line upside. Sometimes legitimacy brings more oversight, not just more demand, but it does show that major economies are not treating this asset class like a temporary toy anymore. They are trying to integrate it into real financial architecture. And if that trend continues, large treasuries sitting on the right networks may look a lot more strategic than they did a couple of years ago. So where does that leave us? It leaves us with a company that looks stronger on accumulation than on explanation. The Treasury story says conviction. The funding story says caution. The staking story says patience. The buyback story says optionality. The dilution story says hold on a second. And the market is being asked to believe all of those things at the same time. That is why this feels like a puzzle instead of a clean investment thesis. I can see the upside, I can also see the confusion. I do not think the whole thing is nonsense. But I do think management has earned the burden of clearer explanation now. Because when you mix a rising coin stack, lower cash, softer fundraising, a giant repurchase authorization, staking income, and a stock that may itself be the discounted form of the underlying asset, you are no longer asking investors for trust. You are asking them for trust plus imagination. There is also that side pocket angle the crowd keeps skipping over. The company still carries what management calls moonshots, including a stake in 8Co, which management has framed as one of the few public equities giving direct exposure to OpenAI, plus a large private company stake tied to Beast Industries. I would not build the whole bull case on those pieces, but I also would not ignore them. In a strange way, they add another layer of optionality to a balance sheet that is already overloaded with strategic choices. If management ever needed another lever besides issuing stock, buying crypto, staking crypto, or repurchasing shares, monetizing or re-rating those side holdings could become part of the conversation. That matters, because when cash gets tighter, every non-core asset suddenly becomes more important. And one last thing. Management has also been leaning into the argument that Ether has held up well even while the Iran war kept driving global markets. And their own filing explicitly says Ether has outperformed gold and the broad equity benchmark since that conflict intensified. Now, I would be careful with turning one wartime stretch into a permanent law of nature. That is exactly where hype can outrun evidence. But I do think it helps explain the mindset here. Management is not behaving like it sees Ether as a trade. Management is behaving like it sees Ether as the asset at the center of the next financial plumbing layer. If that belief is right, this whole structure may eventually look early. If that belief is wrong, then the complexity around it is going to feel a lot less clever. So here's the question. Would you rather own the coin directly or the company that owns a mountain of it while constantly changing the way the market has to interpret the strategy? And second question, is this a masterclass in keeping every option alive, or a setup that only looks smart as long as the asset price keeps climbing? If you are successful, share your success story in the comments so others can stay motivated. For me, the honest answer is simple. This is one of the most fascinating balance sheet stories in the market right now. Real upside, real intelligence behind parts of it. Real confusion too. Not an automatic yes, not an automatic no. Just a very unusual capital allocation experiment that could look brilliant if execution and price line up together, or look like overcomplication if they do not. Treat this as education, not instructions. Use it to sharpen your thinking, then do your own work before putting real money at risk. That is why this setup deserves patience, not hype. That is why clarity from management matters more now than ever before for investors.